Okay, now let's move on to this particular question. Ravi opened a new cafe business and entered into the following transactions for the week starting 1st July 2023. Now you are given set of transactions. The first question, how these transactions will impact the accounting equation. This particular question I have already discussed and I made a video on this. I'll just put the link below. You can go through the video for better understanding. And the second part is, what are the accounting entries required to record the transactions noted in the general ledger. Now the second part, let's focus on the second part. You need to record these transactions. You are given 6 transactions. How those transactions will be recorded in the general ledger. Now when you talk about general ledger, general ledger is where we maintain T accounts. We maintain T accounts. The left side is known as debit and the right side is known as credit. These transactions are recorded in these T accounts based on a principle called double entry accounting system. We say double entry accounting rules or principles. Okay. So based on this double entry accounting rules, we need to record these particular transaction in T accounts. So what do you mean by double entry accounting system? It is also known as dual concept. Each and every transaction should be recorded in these T accounts based on the double entry accounting system. According to this double entry accounting system, when you record a particular transaction in one account, either debit or credit, the other account also should be either debited or credited. Okay, for example, if you debit one account, the other account should be credited. So this is known as dual impact. Okay, so double entry accounting system talks about this dual impact. So every transaction has a dual impact. So once you debit one account, the other account should be credited. So even this particular concept, I have done a detailed video. So what you can do is you can watch this particular video. I'll put the link below and go through that video for better understanding. Now just to recall your memory, just to refresh your memory with regard to this double entry accounting principles, I have given this table. Okay, so basic accounting equation, assets equals liability plus owner's equity. Now when you take assets, there are different types of assets like current assets, non-current assets. Okay, so current assets like inventories, debtors, you have cash balances and the bank balance. All these are current assets. So when you take non-current assets, motor vehicles, plant and machineries, land and buildings, and so on and so forth, you can categorize under non-current assets. So non-current assets are basically we use in the business to generate economic benefits, and those can be used for more than 1 year. Okay, so in the current assets we have all liquid assets less than 1 year. Okay, now based on this, when you take assets, any increase in assets should be debited, any decrease in assets should be credited. This is the rule. Okay, so when you increase in assets means when you purchase a motor vehicle or plant and machinery, it increases the assets of a business. Okay, so therefore you need to debit, and when it reduces, you need to credit. For example, if you sell a motor vehicle, the motor vehicle motor vehicle will go out of the business. So therefore, you need to credit the asset account. So this is the basic rule. Then the liabilities, on the other hand, increase in liability should be credited, because when you take a bank loan, or when you purchase items on credit from your creditors, okay, your obligation towards the providers of finances and providers of materials will increase. Your obligation will increase, liability will increase. So therefore you need to credit. And any decrease in liability should be debited. So which means once you get rid of your loans, once you get rid of your credit supply payments, so you just debit the liability account so that you can reduce the obligation towards them. And owner's equity also, it has two components basically, your capital and the earnings. The same principle, any increase in capital should be credited and any decrease in capital should be debited, because as you know, we have a concept called business entity concept. Business and the owners are two separate entities. So therefore, business has an obligation to pay off these liabilities. Okay, the obligation towards the owner is known as equity or capital. So any increase in capital, if the business owner introduces cash into the business, so the business cash will increase, so you debit the asset account and the capital account will be credited, because business has an obligation to pay off these liabilities. So on the other hand, if the owner has withdrawn, we call it drawings or dividends if it is a company, so we debit the capital accounts. As a result, the obligation towards the owner will reduce. The other thing is the earnings. Earnings means the profit. Any increase in profit should be debited, because the profits belongs to the owners of the company. So therefore you you credit the capital earnings account. You basically you credit the capital account any earnings, so that will increase the obligation towards the owner. Any decrease in earnings should be debited, because if there is a loss, the loss has to be borne by the owner. So therefore, obligation towards the owner will reduce. Now, when you talk about earnings, this is a combination of your revenue and your expenses. Revenue minus expenses will be your profit. So therefore, we don't directly record these transactions in the capital account or equity account. We identify all these transactions separately in the ledger account. Then we prepare the trial balance and the profit and loss account. That profit or loss will be transferred to the equity account under retained earnings. Okay, so first of all, we identify these transactions, revenue items and the expense items. Expenses also, different types of expenses will be there: administration expenses, cost of sales, selling and distribution, finance cost. So all these expenses will be identified under different categories, but the principle is the same. So when you take the revenue, any increase in revenue should be credited, because it will increase the profits. In turn, it will increase the capital or the equity of the owners. Any decrease in revenue should be debited, because that will reduce the profit, and that will in turn will reduce the obligation towards the owner. For example, if you make a sale should be credited. If there is a return, sales return, it has to be debited. So likewise, when you take the expenses, as I told you, any decrease should be debited to the capital account, because the obligation towards the owner will reduce. So likewise, the expenses will result in reduction in the profit, okay, and the capital. So any increase in expenses should be debited, because why we debit the expenses? We recognize this, we identify these expenses separately. So any increase in expenses we debit, because eventually that will result in reduction in the retained earnings. So likewise, any decrease in expenses will increase the earnings and the capital. So this is the basic rule about the double entry accounting principles. Okay, now let's move on to this particular question. uh, Ravi deposited 50,000 of his personal savings into a newly opened business bank account as capital. Now what has happened? The Ravi, the owner, has deposited 50,000 uh, into a newly opened bank account. Okay, so when you take this transaction, the owner has invested this money, so therefore business has received an asset, the bank. So asset increases, therefore you need to debit the asset account. Okay, you need to debit the asset account, and you need to credit the capital account because obligation towards the owner increases. So therefore any increase in capital should be credited. Now based on this, I have the answers for these questions. First of all, any increase in asset should be debited, so therefore we have a bank account and the capital account. So we debit 50,000 and we credit 50,000 in the capital account. Okay, now under description, now here in the description what we write is we have to specify the account to which this amount was debited. This amount was debited in the bank account, so therefore bank name has to be specified here. And when you take the bank account, this amount is credited in the capital account, so therefore the capital account name should be specified here. This is how the double entry accounting system works. Okay, you debit bank account and you credit the capital account. First one. Second one, paid $3,000 by bank transfer for the monthly shop rent. Now shop rent is an expense, okay, and this was paid by a bank transfer, so therefore bank balance will reduce, decrease in asset, so you need to credit 3,000 to the bank account. And expenses increased, any expenses, increase in expenses should be debited. Okay, so when you take the rent expenses, the amount has to be debited here, 3,000, and the bank account should be credited because asset balance is reducing. It reduced the asset balance, the bank balance, so you credit. Any decrease in asset should be credited, so therefore you credit here. Any increase in asset expenses should be debited, so you debit the rent expenses, and the account name should be the bank. The account to which this amount is credited is the bank account, so you specify the bank account, and here the rent expense account should be specified here, mentioned. Third one, paid 12,000 via bank for the purchases and installation of coffee machines and kitchen equipments. Now here the owner has bought coffee machines and kitchen equipment. So what is the nature of the business? It's a cafe business. In order to run a cafe business, you need to sell coffees and other food items. For that you need kitchen items. Okay, so these are non-current assets. The purpose of purchasing these machine is not to resale, just to keep it in the business to produce these items. Okay, so therefore the intention is to keep this machine for a longer period of time, for more than 1 year. Okay, so these are non-current assets. Any increase in assets should be debited, and since this was paid via bank account, the bank balance reduces by 12,000. So therefore what you do, we have to have two accounts, machine and equipment should be debited because increase in assets should be debited, so 12,000. Any decrease in assets should be credited. So bank account is an asset account, current asset, so any decrease in asset should be credited. So basically these are two asset accounts. One asset is one asset is increasing, the other asset is decreasing. Okay, so that's why it's credit and it's here debit. Okay, now paid 1500 from the bank for furniture and lighting for the cafe. Now, even the furnitures and lighting is the main intention is to retain it in the business. You need the furnitures to serve customers, and also you need proper lighting. So all these are non-current assets, and this was paid from the bank account 1500. The same impact, the bank balance reduces by 1500, and the furnitures and fittings account increases, so you have to debit. Any increase in asset should be debited, any decrease in asset should be credited. The same principle. Then fifth one, purchased inventory food and beverages for 800 on credit payable to the supplier in 30 days. Now, to run this business, you need food and beverages. These are inventory items, assets. So he purchased on credit. Now he purchased these assets, inventory items. Increase in assets should be debited, so therefore inventory account will be debited. And since this is purchased on credit terms from the suppliers, your liability towards the supplier will increase now. Okay, so any liability, increase in liability should be credited. That's your obligation. So payable account, accounts payable account should be credited 800. Okay, this is the double entry. Payable account credit 800, inventory asset account debit 800. Then received cash sales from customers amounting to 2400 deposited in the bank. Okay, now this is a cash sales. When you sell uh, on cash, company will receive cash. So increase in asset. Okay, so bank balance will increase by 2400, and from customers amounting to 2400 deposited in the bank. So this is cash sales. Okay, this sales will result in increase in the equity. So any increase in revenue should be credited, sales should be credited, so that will impact your capital, that will result in increase in capital. So therefore the sales account should be credited and the bank account should be debited. Okay, so these are the basic double entries that you need to follow in order to record these transactions, okay, in the general ledger. So these are the answers for the these transactions, this particular question. Okay, uh, now we need to know how to balance these accounts. In the next video I will discuss how to balance this and how to extract the trial balance. Let's see you in the next video. So thanks for watching. Bye for now.